Hello, good evening. How are you all doing? So, today we'll talk about this IMF's report, which is on global financial stability. And International Monetary Fund, which is also known as IMF, has come up with this report. And it's a very detailed study. It has just come out in October, so it's pretty new, and there are very important details as to what's going on in the economy, in the global economy. Where are we at the moment, and what do we foresee to happen in the near future? So this has come up from IMF, so we can expect that to be unbiased, and the quality is expected to be good because IMF is very specialized in doing these kind of works. Okay, you can also download it from the IMF's website, this particular report, but we will go through some of the important things. It's a very long one, but we will go through the executive summary of this report, which is a summary of the detailed study that has happened. Okay, it starts with actually global stability research, key vulnerability of global financial system. So that's the first sentence itself. So you can imagine as to what this study is actually telling us. It starts with the global environment is fragile with storm clouds on the horizon. Just look at the words storm cloud on the horizon, right? You will probably would never expect to read such words in an academic paper, that the global environment is fragile with storm clouds on the horizon. Inflation is now at a multi-decade high. That means in the many decades, inflation is perhaps the highest and broadly spread across country. That means no country is spared. Almost all countries are grappling with high inflation. The economic outlook continues to deteriorate in many countries. And beside inflation, obviously, there is geopolitical risk, which is another thing. And in this sort of a situation, you see other things. So many other things that actually, this report talks about. It is not just about inflation, because in order to gain control over the inflation, the central banks are also raising interest rate. That is having even more negative impact on the economy, right? Because the cost of borrowing is now higher, mortgage rate is higher, a lot of things are higher, so economy is not at all doing well. Global financial markets have shown strengths. Asset prices have sold off on the back of continued energy market pressure, emerging stress in cross-currency funding, and stress in certain non-bank financial institution segment. At the same time, market liquidity has deteriorated across key asset classes. It goes without saying, in a more of a recession, liquidity goes away from the market, and this has happened. There was huge liquidity, right? Because of which you see, we saw a huge spike in the stock prices or asset prices 2 years back. Things have changed since then. Liquidity is still lacking. It is another unique thing about this crisis. And then you have the uncertainty around what is going to happen. So that is even becoming more problematic, because nothing really actually is predictable at the moment. Things are evolving, so probably we haven't seen the worst yet. And it also says that the financial stability risk has increased. That means it's not just the countries which are in trouble. Even the financial system as such is also in trouble. Financial vulnerability are elevated in the sovereign and non-bank financial institution sectors, where rising interest rates have brought in additional stress. A bright light comes from a global bank stress test, which show relative resilience of advanced economic banks. So the banks from the developed economies are doing relatively better. For example, Europeans and Australian banks, Japanese banks, American banks, Canadian banks, these are relatively doing better. But from the ones from weaker economy, emerging economies, they are not doing as good. The challenging economic and policy environment is also putting pressure on the global corporate sector. So, what kind of macroeconomic situation we are talking about? We're talking about the increased interest rate. So, because the interest rate has gone up and it's still going up, there could be revisions, right? We could expect even more higher interest rate in the coming days. Maybe next time the Fed will increase it by 100 more basis point, and that is putting a lot of pressure on the businesses, because businesses are not able to borrow money because of high interest rate. They don't want to borrow, and given the economic scenario where it is not very clear where the economy will go, whether it will recover soon or will there be a prolonged recession, businesses are not confident to even buy. So that is putting even more pressure on the economy. Among small firms, bankruptcies have started to increase because of higher borrowing costs and declining fiscal support. This has already happened. This is already happening in, for example, in Germany. Also, this is happening. That I was reading this report that over 700 firms, small firms, have filed for bankruptcies. This is very concerning actually, because small firms cannot withstand a recession. Small firms will be in more trouble when the cost of borrowing goes up, right? So you expect them to not do well in such scenarios. Okay, many advanced economies and emerging markets may face housing market related risk as mortgage rate rise and lending standard tighten, which is happening, right? Mortgage rate are rising all over the world, including in the US. You might have also read that the prices are falling actually in the US, and lending standards are increasing. So many countries have increased the standard of lending. They are not funding the substandard, less credit worthy mortgages. So this is actually having an impact on the housing market, and in many places, especially in China for example, but also in other advanced country, there is the house prices are going down. So this is one such consequence. Then you have emerging markets confronted with multitude of risk from the strength of the US dollar. Why? Because US dollar is gaining prominence, right? US dollar is gaining more strength. The problem is for many emerging economies is that they want to buy things in US dollar from other economies, because a lot of the emerging economies are import based economy, and they have to spend a lot of money on that. And because of the strength of the dollar, they are paying more money, right? High external borrowing costs, stubborn high inflation. So there is pressure from all sides, right? From the forex side, from the exchange rate side, but also you have from the borrowing cost, because costs in interest rates are high inflation, volatile commodity market, especially even oil market, highlighting uncertainty about global economy, and pressure from policy tightening in advanced economies. In all these cases, the countries which are feeling real pressure are the emerging economy. Without doubt, even the developed economies are also feeling the pressure, especially the European economies, Europe is really having tough time because of the inflation, because of other things. However, investors have continued to differentiate across emerging market economies, and many of the largest emerging markets seem to be more resilient to external volatility. And this is so what he's saying is that the larger emerging markets are a bit more resilient. For example, the Indian economy, Chinese economy, Russia is maybe an exception, but even South African economy, Brazil, the among the emerging markets which are of big size, the economy is of substantial size, the impact is a lot less. Having said that, our updated global bank stress tests show that in a severely adverse scenario, up to 29%, and this is very important to highlight, the bank stress show that in a severely adverse scenario, up to 29% of emerging markets banks will breach capital requirement. So that is about 1/3 of the banks in emerging markets will breach the minimum capital requirement for these banks because of this added pressure. Pressure are particularly severe in frontier markets, generally smaller developing countries where challenges are driven by a combination of tightening financial conditions, deteriorating fundamentals, and high exposure to commodity price volatilities. Especially in African countries, countries like Bangladesh and Pakistan and many African countries, smaller countries of smaller size, I think they are having trouble, real trouble. They're in real trouble because import is now very, very expensive, and that is causing a lot of trouble there. Navigating the uncharted waters of high inflation and tighter financial conditions requires a delicate balance by the policymakers. Central banks must act resolutely to bring inflation back to target and avoid a de-anchoring of inflation expectation. Clear communication about their policy decision, their commitment to their price stability objectives, and the need to further normalize policy will be crucial to preserve credibility and avoid market volatility. I think this is a very good point that the government and the policymakers, including the central banks, should communicate properly to the market. Otherwise, there will be lack of clarity, and people will perceive this as more of an uncertain situation, and which will result in more market volatility. I think clarity of communication should be very, very important as to whether the central bank is is expected to increase the rate or not. So that expected should be very clear, right? Even which has already been made, for example, by the Federal Reserve, that it is still expecting a rise in the interest rate in the coming quarters. Whereas this communication is a bit lacking in less developed economies where the central banks are not providing enough information, timely information, clear information to the market participant or even the general public. At the same time, tightening of financial condition needs to be calibrated carefully to aim at avoiding disorderly market condition that could put financial stability unduly at risk. That means in order to bring down the inflation to the target level, which is 2%, about 2% for developed economy, about 4 to 5% for the emerging economies. Now that the central bank should do, but they should not do to the extent that it really creates a bigger mess, right? The tightening should be more calibrated. That means you increase the rate and you wait and watch for some time, and then you decide whether to increase further or not. So that calibration should happen. The IMF's integrated policy framework for emerging markets suggests a carefully calibrated mix of tools, including interest rate policy, macroprudential actions, foreign exchange interventions, and capital flow measures. So what IMF is suggesting is to have a bit more calibrated. That means a mix of tools to combat the situation. For example, whether it's interest rate policy, which is nothing but increasing the interest rate, right? Macroprudential actions means these are more fiscal side. These are government actions, you know. Then you have foreign exchange intervention, again monetary policy by the central bank, and capital flow measure. I don't know what is capital flow measure, but I expect that is something related to how income can be generated within the government, maybe. In the current environment for many emerging economies markets, managing the global tightening cycle could involve a mix of tools to help mitigate stark monetary policy trade-offs and reduce financial stability risk. Policymakers will also need to continue to scale up private climate finance, particularly in emerging market and developing economies. Climate finance. Okay, I think climate risk is coming everywhere. Regardless of this particular crisis, it was already in news for some time, especially in last couple of years, and this is again in news in these times when it is now being ignored, because some people say, okay, we have bigger fish to fry at the moment with inflation and everything, so let's ignore the climate part, and rightly so. But I think on a longer term basis, these climate risks should also be given due importance. The IMF will continue to help address climate change challenges through its financial stability risk assessment, lending through its new resilience and sustainability trust, and advocating for improvements in the climate information architecture. In addition, reforms for non-bank financial institutions have to continue. The role of open-ended funds featured prominently in 2020 Dash for Cash episode, yet reforms have been lacking so far. Liquidity management tools, including swing pricing, should be considered seriously by policymakers. Policymakers face an unusually challenging financial stability environment. In economic and financial market surveillance to act in a timely and well-informed manner and communicate clearly. It's crucial and is under some. So communication is super important. That's what it's saying. Anyway, some good graphs. Actually, we'll go through some of the important graphs, some charts on this particular paper. Super interesting, and I will maybe increase the size. Global financial conditions. This was in 2008 and 9. Things got bad in Europe area in 2011 and 13. Got better for the last many years, but then 2020 pandemic. We were thinking that things will get better, but I think we are in this situation. Okay, what else is there? Near-term growth at risk forecast. So this is the best case scenario. This is the worst case scenario. So this is about emerging market hard currency sovereign spread, which is about basis point, and it is the worst is with the emerging markets, especially the smaller emerging markets, but I think the bigger emerging markets are doing still okay. And here you have this market implied probability. Okay, let me shorten a bit, it's not very clear. Yeah, this is better. Market implied probability distributions of inflation outcome. So what it is saying is that so chances are that inflation, okay, in terms of percentage, okay, so this is more of a percentage distribution, 4% up, right? So this is most likely, In the Europe, it is a bit uneven. So this is the red. The red one is the latest one, right? Okay, so this is about 4%. Here also it is 4% in KNB. So interest rate and price of the risk. Interest rate and KNB have been extremely volatile since April, reflecting heightened uncertainty about the economic and policy outlook. Risk assets sold off sharply through June on fears that central banks would have to step up the pace of policy rate hikes to fight high inflation. Emerging market assets suffered large losses, and sovereign spread of high yield emerging markets rose nearly to level last seen in March 2019. Crypto markets have experienced extreme volatility, which is expected, right? But I think people are not too worried about crypto market because other economic indicators are not linked to crypto. So crypto is more of a standalone. Even if crypto was doing bad, other indicators would do well, still be a fine market. But I think what is concerning is that the asset prices are increasing. Well, some cases still at a peak. Interest rate is still increasing, and emerging markets are most affected in such a scenario. In the middle of the year, a recession fears grew. Okay, I think one thing is very clear in this case. There is absolutely certainty about recession, almost certainty. On hope that monetary policy normalization cycle would be end sooner than previously anticipated. These moves, however, have been unwound, and risk assets have experienced further losses as major central banks have strongly reaffirmed their resolve to fight inflation and meet their price stability. Yeah, I think it is not a surprise that all the central banks will raise the interest rate to fight the inflation, because without having a stable inflation, it affects the common man, right? The common people the most. I think central banks have the mandate to control that. Then you have US bid-ask spread, a market liquidity. You see a huge gap here, right? And that really is indicating that we are at the verge of a recession. Okay. The last time we saw such a spread was also something in 2021, but I think this is now a bigger issue. Disagreement among investors around most likely inflation outcomes appear to have become more stable. In the euro area, there is a significant odds of both low and high inflation outcomes, likely reflecting heightened concern about slowdown in the aggregate growth. There is a risk, however, that rapid and disorderly repricing of risk in coming months would interact with and be amplified by pre-existing vulnerability and poor market liquidity. Market liquidity metrics have worsened across asset classes, including in markets that are generally highly liquid and among standardized and exchange-traded products. So even though the assets which are where liquidity is not a problem, even there it's an issue. US Treasury bid-ask spreads have widened significantly. So this is more of a risk-free type asset, US Treasury, right? Even there you see a bid-ask spread. That means people are ready to buy. The price to buy and price to sell. There is a gap that is widening. That is not seen in normal markets. European financial markets have shown strengths since the April. Asset prices have sold off on the back of growing recession fears of gas shortage and a re-emergence of fragmentation risk in the euro area. However, spread of the southern European government bond yield over German yields tightens after the European Central Bank's announcement of a new tool to fight fragmentation in the new area. Spread of the Southern European government bond yield over German yield tightens the European central blah blah blah. Okay, I think in the UK, the investor concerned about fiscal and inflation outlook following the announcement of large debt finance cuts and fiscal measures to deal with high energy prices were heavily on market. I think this UK news, as I think you guys already know this. This was an announcement of tax cut and subsidy for the cost of living, the higher cost of living. So government was subsidizing that, and that wasn't perceived very nicely by the markets, because there is a huge revenue pressure on the government as to how the government will be able to fund these programs. That is a concern from the investor side, and hence you saw pounds doing very badly, right? Pound to dollar rate is historically at the lowest level. So this is about emerging market local currency bonds and equity. You have except China and China. China is the behemoth, right? Is one of the biggest emerging market economies. So that could bias the results. But so this is how you see, including China, you see that the bonds and equities are slightly doing okay, but without China, it's doing very badly, right? Which is not unexpected, because we'll see some more graphs. Potential credit losses for Chinese bank related to real estate exposure. So this is more about the exposure, the issue risk with banks' exposure to Chinese real estate. Chinese real estate is not very well financed by external banks, by foreign banks. So it's not going to impact a lot, but still you could see some impact. It's in crisis, by the way, just to mention. The real estate market in China is not at all doing well, and it is going to have an impact. Redistribution of banks by capital adequacy in an adverse scenario. Yeah, you see the problem is more on the emerging market, where chances are that many banks will not be able to meet the capital requirement. And so what is exactly the policy recommendation? Central banks must act resolutely to bring inflation back to target, keeping inflation pressure from becoming entrenched and avoiding a de-anchoring inflation expectation that would damage credibility. That means the interest rates should be well calibrated. It should not be simply increased without any thought. It should be step by step process, and there must be a balance between increasing interest rate to control inflation, but at the same time ensuring that the market is not too impacted by the increased interest rate or the high interest rate. The high uncertainty clouding the outlook hampers the ability of policymakers to provide explicit and precise guidance about the future path of monetary policy, but clear communication about the policy fractions and their unwavering commitment to achieve their mandate objectives and the need to further normalize policy is crucial to preserve credibility and avoid unwarranted market volatility. According to the IMF's integrated policy framework, where appropriate in some emerging economy markets, global tightening cycle cloud, considering using some combination of targeted foreign exchange interventions, capital flow measures, and other actions to help smooth exchange rate adjustment to reduce financial stability. Okay, so exchange rate, yeah, central banks can intervene. Sovereign borrowers in developing countries should control on debt, right? I think debt is a big problem for the emerging economies, very well debt ridden, paying a lot of money as interest. Anyway, it was good discussion. Thank you for joining. We will we'll have another, we'll go through the report in more detail way, maybe in another session. Thank you all who are watching us.